One October morning in 1981, in Cleveland, a man named David Marshall sat at his kitchen counter with a stack of bank papers. David wasn't an investor. He was a mechanic working at an auto parts factory. His income was enough to support his family, pay the mortgage on his small house, and save a little for the future. At least, that's what he believed. On the paper in front of him was a new notice from the bank. The mortgage interest rate on the loan he had taken out 2 years earlier had risen to nearly 18%. That number made David disbelieve his eyes. Just a few years earlier, housing interest rates in the U.S. were still single digits. But now, the amount his family paid to the bank each month had increased to almost his salary. David wasn't the only one in this situation. In the early 1980s, millions of American families suddenly realized that the cost of borrowing was rising at a rate they had never experienced before. Mortgage rates, business loan rates, even credit card rates were all soaring to their highest levels in modern history. This wasn't a short-term policy mistake. It was the culmination of a decades-long interest rate cycle. In 1981, the U.S. benchmark interest rate exceeded 20%. This was the highest level ever recorded in the history of the world's largest economy. But what made this event so special wasn't just the number. It was what happened afterward. Following the 1981 peak, global interest rates began a gradual decline over nearly 4 decades. From double digits, rates fell to single digits, then to near zero. For many, this sustained decline seemed like the natural state of the modern economy. But monetary history tells a different story. Looking back at data over a century, interest rates don't move randomly. They move in long cycles that last for decades. Rules of increase. Rules of decrease. And then back to the starting point of a crisis. In many cases, the time between two major interest rate peaks is typically around 4 decades. That means the interest rate fluctuations we're seeing today may not be short-term phenomena. They may be part of a much larger monetary cycle. A cycle that, each time it returns, sends the global financial system through profound tremors. Tremors that shake asset markets, change the debt structure of nations, and sometimes, expose weaknesses that have accumulated in the system over decades. But to understand why such long interest rate cycles exist, we first need to look at a very common belief about interest rates, a belief that much of the public still accepts as a self-evident truth. The belief that interest rates are simply a tool that central banks use to regulate the economy. The most common belief about interest rates is a rather simplistic explanation. When the economy is overheating and inflation starts to rise, the central bank will raise interest rates to cool the economy. When a recession occurs, they will lower interest rates to stimulate borrowing and investment. In economics textbooks, this mechanism is often described as a sophisticated regulatory system. Interest rates are like a regulating valve, opened or closed to keep the economy running smoothly. That explanation is partly true. But if interest rates were truly just a simple regulatory tool, monetary history wouldn't have witnessed such long cycles of decades. The largest interest rate hikes and dips in history rarely lasted just a few years. They typically spanned decades. From the late 19th to the early 20th century, interest rates in many developed economies remained relatively high for extended periods. Following the Great Depression of the 1930s and World War II, a prolonged cycle of low interest rates began. By the late 1960s and 1970s, inflationary pressures gradually built up in the global financial system. As energy prices soared and the money supply expanded rapidly, interest rates were forced to rise sharply to control the situation. The peak of that cycle occurred in the early 1980s. After that, the world entered a completely opposite cycle. Interest rates began to gradually decline. Not just for a few years, but for nearly 40 years. From the United States to Europe, from Japan to many other economies, the cost of borrowing steadily declined. For many adults during this period, low interest rates seemed like the natural state of the modern economy. Buying homes with long-term loans became common. Businesses borrowed to expand. Governments issued debt at increasingly lower costs. But what few realized was that this prolonged cycle of falling interest rates created a profound shift in the structure of the financial system. As the cost of borrowing fell for an extended period, the entire economy began to adapt to the cheap credit environment. Businesses borrowed more. The government borrowed more. Consumers borrowed more as well. Over time, debt became the primary driver of economic growth. In the early stages of this cycle, the expansion of credit often created a sense of prosperity. Asset markets are rising. Businesses are expanding. Consumers are spending more. But along with that expansion, another consequence is also accumulating. The size of debt in the system is increasing. As debt increases in a low-interest rate environment, the financial system becomes increasingly sensitive to any change in the cost of borrowing. Just a few percentage point increase in interest rates can significantly raise the cost of interest payments for the entire economy. This creates a very unique situation. In the early years of a low-interest rate cycle, lower interest rates helped the economy grow faster. But after decades of accumulating debt, that very factor becomes a weakness of the system. When interest rates begin to rise again, the entire financial structure built during the cheap money era will face immense pressure. Businesses that relied on cheap credit begin to struggle. Governments with high levels of debt face rapidly rising borrowing costs. And asset markets once fueled by cheap money begin to shake. In many previous monetary cycles, this very transition point has often been the source of major financial crises. Not because interest rates rose too high, but because the system had become accustomed to low interest rates for too long. However, to understand why such long interest rate cycles repeat themselves in history, one needs to look deeper into how the monetary system and the debt system interact, a mechanism from which most financial crises originate. To understand why interest rate cycles lasting decades repeat themselves throughout history, we need to look at the very special relationship between three factors: money, debt, and time. In the modern financial system, most of the money in the economy is not created directly by the central bank. It is created through the credit system. When a bank lends, new money is created in the system. This means that each new loan is essentially both an asset and an obligation. A person receives money to spend or invest, but at the same time must repay that debt in the future. In the early stages of a credit cycle, this process can strongly stimulate economic growth. Businesses borrow money to expand production. Consumers borrow money to buy houses and cars. The government borrows money to finance large projects. All of these activities create the feeling that the economy is growing rapidly. But over time, as the scale of debt in the system increases, something significant begins to happen. An ever-increasing portion of income in the economy must be used to pay interest on existing debt. This is like an invisible pressure gradually building up in the financial system. During periods of low interest rates, this pressure may be masked. The low cost of borrowing allows many people to maintain large debts without immediate difficulty. But when interest rates begin to rise, that pressure becomes apparent. Businesses with high debt ratios begin to spend more money on interest payments. Consumers with long-term loans face increased financing costs. Governments with massive debt have to spend more budget on interest payments on bonds. And when many sectors of the economy are under this pressure, the financial system begins to shake. Historically, many major financial crises have occurred at times when interest rate cycles reversed after prolonged periods of decline. The early 1980s saw a wave of corporate bankruptcies and debt crises in many countries as interest rates rose sharply to control inflation. In the early 1990s, several developed economies faced a real estate crisis after borrowing costs increased. By 2008, part of the global financial crisis also stemmed from rising borrowing costs for high-risk mortgages. These events were not isolated incidents. They were the tipping points of a long-standing accumulation in the debt system. The approximately 4-decade-long interest rate cycle actually reflects a broader cycle of credit. In the early stages of the cycle, debt increased alongside economic growth. Interest rates may then rise to control inflation. Then, when the system needs to stimulate growth, interest rates fall and credit expands. Over time, debt accumulates to the point where the economy becomes dependent on low borrowing costs to maintain stability. And it is at that point that the cycle begins to become dangerous. Because the system no longer has much room to lower interest rates further. In many developed economies, interest rates fell to near zero in the period following the global financial crisis. Some countries even experimented with negative interest rates. These policies show that the system is very close to the limit of the interest rate reduction cycle. And when interest rates no longer have much room to fall, any inflationary shock can force the central bank to raise interest rates again. That moment often marks the transition between two phases of the monetary cycle. A phase where cheap credit fuels growth. And a period of rising borrowing costs began to expose weaknesses that had accumulated in the system over decades. But those changes weren't confined to bank balance sheets or macroeconomic reports. As interest rate cycles shifted, their impact began to spread throughout the entire economy, from asset markets to the daily lives of millions of families. When interest rate cycles begin to shift, the numbers on the balance sheet quickly translate into very real pressures in economic life. Throughout the decades of low interest rates, a generation of businesses, investors, and consumers became accustomed to a very special financial environment: cheap money. Long-term loans at low costs became the foundation of many economic decisions. Businesses expanded using credit. The real estate market thrived on long-term mortgage loans. Investment funds used leverage to maximize returns. In that environment, the prices of many assets began to rise sharply. Housing in many major cities increased in price for years on end. The stock market was fueled by cheap money. Technology companies could raise capital at very low costs to expand their operations. All of this created a feeling that the financial system was functioning smoothly. But behind that surface stability, the structure of the economy gradually became dependent on a very fragile condition: the cost of borrowing had to remain low. When interest rates began to rise, this dependence quickly became apparent. A business that had borrowed billions of dollars at low interest rates could suddenly face much higher financing costs when refinancing. A family that had once been able to buy a home with a long-term loan could find that the cost of new borrowing was beyond their means. The real estate market began to slow down. Loans became more expensive. Projects that had seemed viable in a cheap money environment became riskier. The impact of the interest rate cycle didn't stop at balance sheets. It spread into the social structure. As borrowing costs rose, more young people began to postpone buying homes. Businesses became more cautious about expanding production. Governments had to allocate a larger portion of their budgets to paying interest on debt. Over time, this pressure can slow economic growth. But what makes the interest rate cycle dangerous is not just the slowdown in growth. It's the weaknesses that have accumulated in the system during the period of cheap money. Businesses that depend on cheap credit. Asset markets that have risen too quickly. Banking systems that hold large amounts of valuable collateral that depend on the low interest rate environment. As borrowing costs rise, these weaknesses can begin to surface almost simultaneously. In many cases, that very moment becomes the catalyst for financial crises. It's noteworthy that monetary history has repeatedly shown that major crises often occur near the end of a long interest rate cycle. Not because interest rates themselves create crises, but because the change in interest rates exposes debt structures that have become too large for the system to handle. After each such crisis, the financial system typically undergoes a period of adjustment. Central banks cut interest rates to stabilize the economy. Governments implement stimulus programs to support growth. Asset markets gradually recover. And then a new cycle begins. A cycle in which credit expands again. Debt accumulates again. And the monetary system once again approaches the point where it will face the familiar pressures of history. Such cycles don't happen in a few years. They last for decades. And that's why many people living within the system often don't realize they are in part of a much larger cycle. But looking back at monetary history over generations, one thing becomes very clear. Interest rate cycles are not just an economic phenomenon. It is a deep rhythm of the global financial system, a rhythm that, each time it returns, confronts the world with familiar questions about debt, currency, and the stability of the economic system. Looking back at monetary history across generations, the interest rate cycle seems like a slow pulse of the global financial system. It doesn't make headlines. It's not a single event like a banking crisis or a stock market crash. Instead, it unfolds slowly over decades, almost imperceptible while people are living within it. A generation that grew up during a period of low interest rates will see cheap money as normal. They build businesses, buy homes, invest, and plan their finances based on the assumption that the cost of borrowing will always be low. Another generation that grew up during a period of high interest rates will have a completely different memory. For them, borrowing money is always a big decision, and the cost of capital is a defining factor in any business plan. These two experiences create two different perspectives on the economy. But when these generations are placed side by side in the flow of monetary history, they are essentially just slices of the same cycle. A cycle where interest rates rise as inflation and debt accumulate. A cycle where interest rates fall as the system needs to stimulate growth. And then the cycle returns to its starting point when the debt structure becomes too large to sustain. Each time this cycle is complete, the financial system usually undergoes a period of profound adjustment. Sometimes it's a banking crisis. Sometimes it's the collapse of a major asset market. Sometimes it's a shift in the global monetary structure. But whatever the form, the end result is usually the same. The system is reset. A new cycle begins. The lessons of the previous generation are gradually forgotten. And after years of stability, the conditions that once led to the crisis gradually reappear. That is one of the biggest paradoxes of the monetary system. Prolonged stability often creates behaviors that lead to future instability. When money is cheap for many years, debt increases. As debt increases, the system becomes more sensitive to interest rates. And when interest rates are forced to rise to control inflation, those debt structures begin to show weaknesses. The 40-year interest rate cycle is not a rigid rule of economics. But history has repeatedly shown that such long rhythms exist in the financial system. These rhythms are shaped by human behavior, by monetary policy, and by how economies respond to crises. And when looking at the fluctuations of interest rates in the modern world, a question begins to emerge. Are we in the midst of a familiar cycle of monetary history? Or are we entering a new phase where the old rules of the financial system are beginning to change? No one can answer that question with certainty. But monetary history has repeatedly reminded us that long cycles of interest rates rarely end quietly. They usually conclude with events that change how the world views money, debt, and economic value. And each time such a cycle closes, a new chapter of the monetary system begins, often very different from what people were previously familiar with.